Okay, gentlemen, I'm going to try something new. It is about 2:45 in the morning on Tuesday night slash Wednesday morning. Uh, that's correct. I just came back a little bit early from work to put this video together for you guys. I actually broke off you four. This is for Lior, Shmuley, Yaakov, and Effie now. I actually broke you guys off from the main group that I'm working with, just because. I don't know, maybe it's stereotypical, but I just find that from people generally think more alike and work at a different speed and pace. The math comes more intuitively to them. Maybe it's cultural, maybe it's the Gemara, that we've all learned at some point in our lives. I couldn't tell you. Only I can tell you that, that's been my expectation. That's been my experience, and that's my expectation of you guys, given talking to you all, and knowing the three of you. Effie I just met, but Leo, Shmuel, and Yaakov knowing or Leroy and Shmuley knowing for many years. So, in any case, I want to get into some stuff that I did this Monday. Lesson one, so to speak. I just want to remind you guys a couple of things. First, we're only going to cover objective number one here, but I have three kinds of options that I write with three kinds of objections. There are CCs and CSPs. That's covered calls and cash secured puts. I'm going to be calling them for the first few lessons I put together for you guys, covered calls and cash secured puts, but eventually I'm going to get down to the lingo of CCs and CSPs because it's going to make things much quicker for me to put things together and just to bring you guys up to speed for the lingos. But even though we're only going to cover the first one today, I want you to have a basic recap of what all three are. The first thing I do is I write covered calls, and I write that in order to enhance returns. A covered call is when I own 100 shares of a company, and I give somebody else the right to buy the company from me for a certain price for a certain amount of time. In exchange for that, I get paid money up front. Um, for instance, if I own XYZ stock and it's currently $100 a share, I might give somebody else the right to buy it from me at $110 a share. In exchange for that, I'm going to get 30 cents, making the numbers up. But in that scenario, I get paid 30 cents upfront, or $30 because it's for 100 shares. And as long as that stock stays below 110, then I keep that money, and and the option expires worthless. But if the stock does go above 110, I am forced to sell the stock to the shares to that guy at 110. And so, that's, we're going to get to the risks in a second, but that's what a covered call basically is. A cash secured put is a bit of the inverse. I don't own the stock, but I'm willing to. I'd like to own the company, but rather than buy it in the free market, I want to get paid in order to buy it at a lower price. And so what happens is if XYZ is 100, I might write a put for 95. Now, I wrote the put, which means that if the stock drops, somebody can force me to buy it at 95, which is okay with me because I'm willing to buy it now at 100. And in exchange for that, I get paid. So this is a way to get income while you're buying stocks, hopefully at a lower price. There's a risk. The stock could run up and you never get to buy it, but it's a risk I'm willing to take, as is with all of these options. I'm not going to get too much into synthetic puts, which is another way of saying there's a covered call in order to buy. It's basically it's called a synthetic put because it's basically an identical calculus to cash secured puts, but it's done through through writing calls and buying on stocks that you buy, and I'm not going to get into it too much now, but it's the same thing. But this is done in a margin account, which you guys may have, may not have. In order to, it's done for different reasons. But it's basically, once you understand the concept of cash secured puts, you will then understand the concept of covered calls synthetically relatively easily. So I don't want to get too much into explaining it beyond that until we've done cash secured puts. But today, again, we're only going to do covered calls. I'm going to recap covered calls, tell you how I set my objectives for covered calls, and then I'm going to show you three real world examples that I did on Monday of covered calls that I wrote on stocks I hope that you're all familiar with. Okay, so lesson one, covered calls to enhance. Just to review the mechanics, as we said, when you own a covered call, you're covered by the 100 shares of stock that you already own. Each call, a single call, it represents 100 shares. And when I sell, so what'll happen is when I own that company, I will want to enhance my return on owning that company. So I will write a call. I will get paid to give somebody else the right to force me to sell it to him for a certain amount of time at a certain price. So for instance, like I said, XYZ, if you buy XYZ stock at 100, I can write a covered call to to somebody, let's say for 110, where I get paid 30 cents. So in that scenario, and let's say it's for the end of the, I usually write weekly options. So this is for the end for the rest of the week, which means until Friday at the market close, this person who owns the call can force me to sell XYZ at 110 if he wants. Now, obviously, if XYZ is below 110, he's not going to force me to sell it at 110 because he could just buy it in the market for cheaper. But from his perspective, if the stock goes above 110, now he's locked in the right for 110. So if the stock goes to 120, I have to sell it to him for 110. But the reality is those options expire worthless the vast majority of the time. But that's the basic mechanic of it. The objective for me is I want to continue to own the security and enhance my return. Because remember, if I'm scraping out an extra 2, 3, 4, 5, 10% over the course of a 35, 40-year investing career, that means that at the end of my career, I'm going to have exponentially more money. Yeah, minimum, 2.5x, likely closer to 5 to 10x what I would have had otherwise if I'm able to achieve my objectives, which so far, B'lian Hara, I have been able to do, but there's no guarantee that it'll continue in the future. But I'm just showing you how I do this. Okay, I will target on these stocks generally between 3 and 15% of extra return every year, or added return per annum. Why would I target 3% in one stock and 15% in another stock? That's because of my conviction on the stock, how badly I want to own the stock. Because generally, when I get paid less, that's when there's less of a risk of me losing the stock. The strike price is further away from the current price. It'll make more sense if you didn't follow that when you see the actual examples. But the more I want to own the stock, that means the less I'm going to get in return for it because I'm going to be more secure. I'm going to hopefully have the option expire unused, and I'll get to keep the underlying stock. Now, there are two major risks when you're writing covered calls. Risk number one is opportunity cost. If the stock gets called away, you write that call on XYZ stock for 100, it gets called away to 110. I'm sorry, you write the call on XYZ while it's at 100 for $110 a share, and now it runs up to 140. It doesn't happen often, but it does happen. That means that I'm going to be forced to sell to this guy anyway for 110. I made a commitment, I have to honor it. And that means opportunity cost, those $30 a share I would have had, 30% return, I lost. That does happen sometimes. Hopefully you're making up for that with the call premiums you're making over the course of the years. But that being said, guarantee you, if you're successful and you're in this for long enough, you will have that happen to you. It stings every time, but it's worth it. It's worth it. And by the way, very often when it gets called away from you, you begin writing puts to buy the stock back eventually, and very often it does come back to you. Not always, though. And the other risk is if the stock declines. In that scenario with XYZ, I wrote the call for 110, the stock's at 100, I got paid 30 cents, but now the stock drops to 80. Now I'm down 20 bucks a share. Now, again, that's a risk in owning the stock anyway. If I own the stock without the option, I'd be down 20, which is true. But still, if I write an option, the stock could still go down. And you can still lose money that way. And that does happen all the time. All the time. I'll write a call and the stock is down. But I like the stock. I would have owned it anyway. So that's a risk I'm very willing to take. But just so you know, that is the second major risk when writing covered calls. Okay. Now I want to explain to you. I don't know how well I wrote this, but I want to explain to you how I hopefully get the juice without squeezing too hard that I lose the stock. And so that means that how do I target how much money I'm going to be how do I target what strike price I'm writing the option at, meaning what price I'm letting the other guy force me to sell it to him for, and how much money I'm looking to get. And so basically I will identify my target return. So I said I usually look between 3 and 15%. So let's say I love a company, and let's say I like a company, XYZ, for example, that I have over here. And let's say XYZ is at $211 a share. I don't know why I chose such an uneven number, but in this case I did. And let's say my desired return, because I like it, is 5%, closer to the 3% side, to the lower end of my 3 to 15% scale. So if I want to get 5% extra a year on that, then I'm going to need an extra $10.55, simple math, times 0.05 on that $211 stock. And so most options trade weekly. Others that I do, there are a few stocks that I trade that only trade options monthly. A few even trade daily, but I don't usually look at the dailies. I usually do weekly or monthly. So now that so once I know how much I'm looking to earn, so for instance in this example of XYZ, I'm looking to earn $10.55 a year. You simply divide the option by those intervals to know your current goal. So if XYZ trades weekly options, you're going to divide $10.55 by 52 because that's how many weeks there are in a year. And you'll know you need to get 20 cents a week in order to achieve your objective. Or if it trades monthly, then I wrote 1055 divided by 52, but I'm sorry, whatever. So you'll know that you need to get 20 cents monthly in order to weekly in order to achieve your goal. I apologize for this. I'm not going back and doing any edits. I'm not looking to put this up on YouTube for money, so you're gonna have to deal with my misspeaks, etc. If I was actually a YouTube influencer or a content maker, I would go back and adjust these out, but you're just getting the raw unedited, unfortunately. Sorry, guys. Okay, but continuing that train of thought, if I need $10.55 a year to achieve my objective and the stock writes options monthly, then I would need 88 cents a month, 88 cents a month in order to achieve my goal. And I would know that, looking in. So now let's look at that in real world examples, and hopefully this will all become clearer to you. And then you can rewatch this and understand what I was trying to say through my headache-addled brain. Okay, so this is an actual option that I wrote this Monday, on Monday, and I took a screenshot of what was going on at the time. So AMZN, Amazon, is a company I'm pretty sure you're all familiar with. Amazon's a high conviction stock of mine. I would like to own Amazon for a long time. So I prefer not to lose it. So I'm only targeting a 3% return on Amazon, the lower end of the return, because I'm looking to keep it. I'm on the lower end of the of my desire spectrum, and so as a consequence, 3% a year is times 0.03 means I need $6.25 a year in order to achieve my 3% goal. And since Amazon trades options weekly, that comes out to 12 cents a week. So I only need 12 cents a week. So on the right, if you look, this is at the exact time I was looking at this on Monday. These were the options that were available to me. And if you'll see, the $225 call seemed to be my best bet because it was right around 12 cents. It was asking for 11. It was, the bid was at 11. The stocks trade, you buy at the ask and you sell at the bid. That's the spread when you'll see like 11 by 12 on stocks. So, I put in a limit order to sell the options for 12 cents, and lo and behold, I got filled at 12 cents a share. And so I was able at a 225 option, as you see over here. So now if Amazon trades above $225 a share, I'm going to be forced to sell it at that price, but it's unlikely to happen. It's unlikely to happen, and I was able to get my $12, which over the course of a year would come out to around $6.25, which would achieve my 3% goal. In case you're curious, I'm looking right now, and Amazon is currently at $211.37, so it's up. I'm thrilled to hear that, but it's not up enough that I'm within real striking distance at the moment, at least, of the 225 price. So I'm hoping that my objective will be achieved and that I will get to keep Amazon at the end of this week, while still getting the little extra juice that would end up yielding an extra 3% for me on that stock over the course of the year. Okay, next, Alphabet, ticker GOOGL. It may sound like Google, and that's because they used to be called Google, and their largest property driver is Google, but now they have all kinds of autonomous things, AI things. Of course, they own YouTube, so they're a much bigger company than just Google. So they named themselves Alphabet, which I think is a bit of a ridiculous name, but doesn't matter. That's neither here nor there. To demonstrate that they cover everything under the sun. Amazon, if their logo is A to Z, they cover everything under the sun. Google is Alphabet because they also want to suggest to you that they cover everything under the sun. So in any case, as you can see on the right, at the time I was looking at the option, Google is 158.62. Now I have a moderate conviction on Google. Why a moderate conviction? I like the company, but there are many questions about the company. They just lost a major court case overseas about a monopoly they might have to get broken up, which is not the end of the world, but it definitely would be make things complicated, and I like to avoid complication. Apple just announced that their Google browsers were not having as much search as good results on search as they used to have. They might be losing ground to AI. I don't know. There are too many questions around Google that I don't love the stock like I used to. However, out of all the stocks that I own, Google is priced very low relatively to its competitors, which means that it's cheap. So because of that, I like Google, but I don't love Google, and so I'm targeting 10%, which means that $158.62, I am targeting $15.86 a year, or weekly, because they trade options weekly, 30 cents a week. So if you look at the chart that I saw over here, that'll put me squarely around the 165 call. Now, 165 is much closer to the current price than Amazon was. It's only $6.38 away from the current price. If you remember Amazon, we wrote the 225 calls when Amazon was at 208, so that was $16.50 away. This is much closer. But I'm willing. I don't want to lose Google, but if I do lose it, it won't be the end of the world to me. Especially if I'm selling it at a price of 165 at a higher price, I'll have made the extra $6.50 almost also. And then I'll simply, if it does get taken away from me, I'll begin to write puts to buy it back to hopefully get paid to buy it back. But in any case, that's what I did, and voila, I wrote the option. I got paid 31 cents. Now, you notice in the Amazon case, I got paid more than the current price. In the Google price, I got paid a little less than the current price. This happens, so be it. But still at 31 cents put me above my 30 cents a week requirement. So, that would still, if I made that kind of return every single week, I would eventually yield more than 10% a year extra on my Google. And in case you're curious, Google is currently $159.53 a share. This is as of Tuesday night / Wednesday morning. So 165 still looks relatively safe, but it is possible that Google get taken away from me. And if it does, I am willing to accept that risk. And the last one, which you guys all should be familiar with, is Airbnb. Airbnb is a stock that I happen to like the company a lot, Airbnb, but it's had a recent run up. There are other companies in the category that I like also, like Booking Holding, which is ticker PCLN. And so I'm much more willing to have Airbnb taken away from me, especially because since it's so volatile, if it gets taken away from me, I'm very likely to be able to buy it at a cheaper price again, later on if I write in cash secured puts below what I end up selling it for. So, in any case, so I have a lower conviction on Airbnb, and so I was targeting 15% in Airbnb. Now, at the time on Monday when I was looking at the options, Airbnb was trading at $133.81 a share, which you can see from the bottom of the chart on the right. That would be $20. And in order to get 15% on $133.81 a share, I would need to get $20.07 a year, or 38 cents a week. So again, I began targeting 38 cents a week. And if you look, the 140 call seemed to be that sweet spot. It was $6.19 above the current price. So hopefully it doesn't get taken from me. But if it does, I would make $6.19 a share because I would sell it at 140 plus the extra 38 cents that I made, and that would make me a happy camper. Of course, I wouldn't be thrilled if it ran up to 160 and I had to sell it at 140, but it's a risk I'm willing to take. And so I sold, eventually I was able to sell this option at 140 for 42 cents. And so that was more than my goal. So I'd probably make closer to 16% on this trade if it doesn't get taken away from me. But I do have to sell it for 140 if the stock goes above that, which is much more possible. And of course, if you look currently, Airbnb is at $138.05 as of right now, which means it's still below 140, but it could end up being taken from me if it goes above 140. And again, it's a risk I'm willing to take. But that's that's the third example. So I hope this helped. I hope this on some levels able to explain to you why I might write covered calls, why I might target X price for this call and Y price for that call, and then to see some real world examples from Monday with 3 known stocks that I don't know if you can afford those stocks, but if not, you can just translate that into lower price stocks, and I can help you find those as well. But into stocks that you might potentially be able to own on your own and write options against that I did in my own portfolios. And that's it. I'm new to this. I understand it was sloppy. I understand there were lots of ums and talkings over myself and unclarities. That's because I wasn't editing this. I just did this all in one take. But that being said, feedback that I might not have thought of. This was literally the first time I ever used WorkNote. I don't video record very often either. And so this is new to me. So if you have any advice or feedback I'd be open to it. Just be kind. I'm still a person, and I take things personally sometimes, but I really do want it. So just say it nicely, and I would be grateful for that. And let me know what you'd like to see also, and if this was useful at all. All right. Only love to all of you guys. Be well, and good luck. Bye.